If you've been watching New York and thinking, why are US stocks and treasuries getting hit because something happened in Tokyo? This is the missing link. For decades, Japan was the world's quiet, safe harbor of cheap capital. Not because returns were exciting, but because funding costs stayed low for so long that the yen became a global utility, a currency you could borrow, park into higher-yielding assets overseas, and roll forward again and again. That created an invisible structure I call the liquidity bridge. Tokyo provides the low-cost funding and the steady buyer base, while Western markets absorb that flow as demand for treasuries, credit, and risk assets. When Japan's long-term bonds crack, the bridge doesn't just wobble, it pulls on everything tied to it. So what cracked? In late January, Japan's super-long bonds, especially the 40-year Japanese government bond, moved in a way they almost never do. The 40-year yield pushed above the 4% zone and briefly tagged new highs around the low fours. That matters because long bonds behave like levers. The longer the maturity, the more violent the price swing for the same yield change. A 10 basis point move in a 40-year bond can translate into a portfolio shock because duration and convexity are enormous out there on the long end. If you don't speak bond math, here's the simple version. When yields rise, bond prices fall, and the longer the bond, the faster it falls. Now, yields don't rise in a vacuum. The market was already on edge because Japan has been stepping away from decades of ultra-easy money. The policy rate had been lifted to around 0.75%, the highest in decades, and investors started to price a world where Japan is no longer the cheapest place to borrow forever. At the same time, Japan faced a burst of fiscal uncertainty, big spending promises, tax cut talk, and election season timelines. When investors smell heavier issuance into a market that's losing its central bank backstop, they demand more yield. That's a polite way of saying they push bond prices down until the yield compensates them for the risk. So the 40-year yield jumps, and the bridge starts collapsing in two directions. Direction one is fast and messy. The death of the yen carry trade. The carry trade is simple in concept and brutal in practice. Borrow yen at a very low cost. Use that borrowed money to buy assets that pay more or simply trend upward. US treasuries, corporate bonds, emerging market debt, and the equity side of the world, including tech. As long as funding stays cheap and the yen is weak or stable, the trade feels effortless. You're collecting the difference, plus you're riding the trend. But when Japanese yields rise and the market starts believing Japan's rates can keep rising, the cost of holding that trade explodes. Hedging becomes more expensive, volatility increases, and the yen can strengthen sharply when traders rush to buy it back to repay funding. That is the moment the bridge becomes a trap. Because to repay yen loans, investors don't sell what is hurting. They sell what is liquid. They sell the easy-to-sell stuff in New York. This is why a yen shock often shows up as a red day in US growth and tech. It's not a verdict on the companies, it's a mechanical liquidation. Here's the mental picture. A hedge fund runs a portfolio of winners in New York, funded by cheap yen. When the yen moves against them, their broker doesn't accept a speech. The broker accepts cash. So the fund hits the sell button on the most liquid assets to raise cash fast. That selling pressure becomes self-reinforcing as risk models tighten and margin requirements rise. Direction 2 is slower, bigger, and far more important. Repatriation by Japan's whales. Japan is home to enormous pools of capital, pensions, insurers, banks, holding foreign assets. Many of them own US bonds because the US yield looked attractive for years. But here's the catch. For a Japanese investor, the true return on a US Treasury is the Treasury yield after currency hedging. If hedging is cheap, owning US bonds can make sense. If hedging is expensive, the high US yield gets eaten alive by the cost of protecting against currency swings. That's why you'll hear traders talk about hedged yield or FX hedged carry. It's the real scoreboard. So when Japan's long-dated yields rise into the high 3s or low 4s, and hedging costs stay elevated, suddenly the home market looks competitive again, sometimes more attractive, especially for conservative institutions that care about matching long-term liabilities. That's the repatriation channel, selling foreign bonds, converting proceeds back into yen, and buying domestic JGBs. To make this concrete, imagine a US 10-year yield in the mid-4% range. Now subtract the cost of hedging dollars back into yen. If that hedge costs something like 3 percentage points in stressed periods, your safe US bond might only deliver a low single-digit return, or less, after costs. Meanwhile, a domestic super long JGB, yielding around 4%, suddenly looks competitive without the currency headache. When that comparison flips, the incentive flips. And because these institutions operate at enormous scale, their decisions don't stay on a spreadsheet. They become flow. Flows move prices. Prices move risk models. Risk models trigger more flows. That feedback loop is what turns a Japanese bond move into a Western sell-off. Think of it like a bridge made of two cables. One cable is cheap funding for leveraged players, and the other cable is steady long-term buying from Japanese savings. When both cables tighten at once, funding becomes pricier and buyers start coming home. The bridge doesn't just sway, it pulls. That's why the same tickers tend to take the first punch. Index futures, mega-cap tech, and the deepest Treasury maturities. They're not the problem, they're the exit door. When a fund needs cash before the close, it sells what it can sell in size. Bottom line, it's market plumbing. When funding tightens, selling spreads fast. No speeches, just margin and math today, now. And when the whales sell US Treasuries, the West feels it immediately. First, US yields creep higher because there's more supply hitting the market. More sellers means the Treasury market has to clear at a higher yield. Second, higher yields pressure equity valuations, especially long-duration stocks, the kind whose value depends heavily on earnings far into the future. When discount rates rise, those future cash flows are worth less today, even if the business is fine. So the same Tokyo move can hit New York twice. It can trigger carry trade unwinds that dump liquid risk assets, and it can trigger Treasury selling that pushes discount rates up. Now, why does the 40-year JGB specifically matter? Why not the 10-year? Because the super long end is where confidence becomes fragile. It's the part of the curve that needs real buyers with real long-term conviction. If that buyer base hesitates, price moves get exaggerated, and exaggerated moves create collateral problems. This is where the contagion risk lives, margin and mark-to-market. Even safe bonds are used as collateral in the financial system. When bond prices fall, collateral values fall. Lenders ask for more margin. That forces selling elsewhere. And again, the selling shows up where liquidity is deepest, the US. At the same time, banks and insurers can hold bonds for years, but markets mark them to today's price. When yields surge, bond prices drop, and unrealized losses become real constraints. Balance sheets tighten, liquidity becomes precious, credit standards tighten quietly. A system that was relaxed becomes defensive. If you remember the lesson from past regional bank stress, it wasn't the idea of losses that mattered. It was the speed at which losses collided with deposit behavior, funding markets, and confidence. Speed turns a balance sheet issue into a liquidity issue, and liquidity issues travel. So what does liquidity bridge mean in one sentence? It means Japan isn't just a country in the global market. Japan has been a funding engine and a buyer base. When the engine changes gears, global prices reprice. Now, what should you watch to know if the bridge is stabilizing, or if the unwind is still rolling? First, watch the pace of Japanese yield moves. A slow climb can be absorbed. A jump is what triggers forced behavior. Second, watch dollar-yen volatility. Stability suggests funding markets are calm. Sharp swings suggest carry trades are being unwound, and hedges are being adjusted urgently. Third, watch super long auctions and demand signals. Strong demand is the market saying, we can digest this. Weak demand is the market saying, we need a higher yield to find buyers. Fourth, watch US real rates and financial conditions. If Treasury yields push up while credit spreads widen, that's the classic squeeze. Higher funding cost, plus tighter risk appetite. And finally, watch headlines for any sign of stress at large institutions that are heavy holders of long-dated bonds. You don't need a collapse to get damage. You just need cautious behavior that reduces lending and liquidity. Here's the takeaway. The 40-year Japanese bond isn't just a retirement asset, it's a cornerstone of global liquidity. When its yield surges, it behaves like a margin call on the system. Funding costs rise, hedges get expensive, collateral values drop, and forced selling shows up where liquidity is deepest. New York. If you want to understand why Wall Street can bleed because Tokyo jolted, remember this line. Capital doesn't move because it wants to. Capital moves because it has to. This is education, not financial advice. If you want more breakdowns like this, simple mechanics, no hype, subscribe, and tell me in the comments, do you think the bridge stabilizes, or do you think the unwind has only started?